cool. I have to have massive amounts of caffeine. All right, good morning, everybody. Thank you so much for being here on a Friday morning. Really appreciate it. I think we'll get started. Thanks again for being here. I have gotten in trouble for not mentioning in past events that we are streaming online right now, and the event will be on the internet far and wide, so everything we say is going to be read by a lot of strangers and heard by a lot of strangers. So there's that. And thanks for being here. My name is Christopher Leonard. I'm a Schmidt Family Foundation Fellow here at New America. And that's just a long way of saying I'm a business journalist who's based here, and I write about big corporations. And as a business journalist, I could not be more excited than I am today to host Bethany McLean, who, this is going to get really embarrassing, but is like legendary in my circles. Bethany is one of the best reporters working today covering the financial system. And she's best known, I think, for the article she published in Fortune magazine in 2001, which had the really innocuous headline, "Is Enron Overpriced?" And as events unfolded, it turned out Enron was overpriced, in fact, and the price rushed to zero, based in large part on Bethany's really diligent and thorough reporting on one of the most opaque and complicated accounting scandals ever perpetuated in the United States. And then Bethany co-authored the really definitive book about Enron, The Smartest Guys in the Room. And then, unfortunately for everybody, Bethany had a lot of work to do over the next decade as she covered financial institutions, Wall Street, the mortgage market, all leading up to the financial crisis in 2008. After which, Bethany and her co-author, Joe Nocera, wrote what is really the best single book about the financial crisis, which I recommend to everyone, All the Devils Are Here, which is the best book because in one volume it's not just about the drama of the financial crisis. It's not just Henry Paulson throwing up in his wastebasket at work and people shouting at each other over the phones. It really traced the root of the rot in the financial system that caused the collapse. And it really explained in an elegant way this complicated machinery that's at the heart of the financial system that caused the collapse, which is so important for people to understand. Unfortunately, it's just as relevant today, I think, as it was in 2008, because a lot of the lingering problems that remained unsolved after the financial crisis, and one of the most important, one of the biggest problems that has still not been resolved 7 years later, is the subject of Bethany's new book, Shaky Ground, The Strange Saga of the U.S. Mortgage Giants, which we'll talk about today. This book is about two gigantic financial institutions that are very bizarre hybrids of public institutions and private companies. They're deeply conflicted. They're arguably, I'm going to say this, as unstable today in some ways as they were in 2008. And it's one of these complicated problems that we've not been able to solve. And Bethany really lays out the contours of this excellently in the book. So let's just jump right in and start talking about it. Bethany, thank you so much for being here.
Thank you so much for having me. Thank you all for coming, particularly on a beautiful Friday.
Yes, exactly. I think this can be a convenient excuse to get out of work, frankly, for a lot of people, so it's good. This book is seriously astounding and bizarre to read. Strange saga is a great phrase. And when I was reading it, I kept getting reminded of that joke that David Foster Wallace famously told about two goldfish swimming along, and another goldfish swims by and says, "How's the water?" And then when one goldfish turns to the other and says, "What the hell is water?" And this is one of those books that describes the water. It describes this huge part of our economy that we take for granted, but is kind of hidden from view. And it describes this bizarre thing called a 30-year fixed-rate mortgage that is a weird Frankenstein of a financial instrument in some ways that we just sort of take for granted. So I thought it'd be helpful today to start at the beginning so we can really all understand what Freddie, Mac, and Fannie Mae are, and then we can talk about the problems going on today. So you talk about in this book how this really all started in a way in 1938. I think might be a good starting point.
Yep. So it's really interesting. There's never actually been a good way of financing homeownership. It's not like somebody has discovered the perfect recipe and we've somehow strayed from that or lost sight of it. So there were all these busts and booms in homeownership and scandal leading up to the Great Depression. And in the wake of the Great Depression, Roosevelt obviously tried a lot of things, and one of them was more federal involvement in homeownership. And as a result of that, we set up lots of structures. But one of them was this idea for this thing called Fannie Mae that was supposed to buy loans that were made by lenders. At that time, just the FHA, the Federal Housing Administration. And that the idea was that if somebody was there to buy the loans, that would free the original lender up to go make more loans. And it would help encourage lending for home ownership across this great, diverse country of ours. And the funny thing is that this sort of controversy about government involvement, or the question of, well, should the government be doing this or should the private capital be doing this, dates right back to the very founding of Fannie Mae. At the time Fannie Mae was created, the idea was private capital would be Fannie Mae. The government even offered to match any private institution that would do this dollar for dollar in order to get this market going. No private lenders ever showed up. So the government ended up doing it in the form of this institution called Fannie Mae, which was part of the government until the years of the Vietnam War, when it was actually privatized in order to get it off the government's budget, so that the government didn't have to be responsible for the debt associated with Fannie Mae, and that resulted in this what was its hybrid structure up until the financial crisis, where it was part private institution with shareholders that it had to please, a mandate to produce profits for the bottom line, and yet part government-sponsored enterprise, which sounds like a mythical beast of some sort, with these weird responsibilities to promote home ownership and these special favors from the U.S. government. And kind of the most important of those special favors, and the most controversial one, was that everyone always believed that the U.S. government would stand behind Fannie Mae and Freddie Mac, its smaller sibling that came along in the 1970s, in the event of a crisis. But yet that wasn't but the official line was, no, we won't. So this became known as the implicit guarantee, this idea that the government would stand behind them, although everybody said they wouldn't. So it was this weird sort of head fake of an idea in many ways. And it led to a lot of complaints about an inherent conflict. How can you be part public and part private? What is that? What is this thing called the implicit guarantee? At the same time, this system that was set up actually worked really well. It succeeded in taking this thing called an American mortgage, which could be made to a poor homeowner in Kansas or a wealthy homeowner in LA, and turning it into this instrument that was sold around the globe, because Fannie and Freddie began to package up mortgages, package them into securities, and sell them to investors around the world. And because Fannie and Freddie stood behind them, guaranteeing the timely payment of interest and principal, the investors around the world didn't have to go through 100,000 American mortgages and look at each and every one and say, is this person really going to be able to pay? Instead, the investors could just say, okay, Fannie and Freddie are there standing behind them, and yes, we think the U.S. government is there standing behind them, and so we'll buy these things. And so in this way, this most domestic of assets, a home, literally rooted on our soil, became a global financial product, because a saver in China could and did finance the purchase of a homeowner in Kansas.
And you point out, you walk through really well in the book, what was surprising to me is that the 30-rate fixed-rate mortgage is not a great investment.
Well,
or it's at least risky in weird ways we don't think about.
It's risky for the lender. So part of the problem with the mortgage market is that this thing called the 30-year fixed-rate mortgage, something we all take for granted. I think over 80% of people who took out a mortgage in the past year took out a 30-year fixed-rate mortgage. It's something that Americans think of as a right. And yet it exists only in America and tiny Denmark, I think, as well. And it exists because of the government presence in our housing market. And the reason for that is that lenders don't like credit risk. They have never liked credit risk. They don't want to have to go through 100,000 mortgages and evaluate every single one to see if people will be able to pay. And so I think most people accept today, not all, but most people accept today that if you didn't have the government in the market, a 30-year fixed-rate mortgage would not exist for most Americans most of the time.
And as you say, it was because of this implicit guarantee that the U.S. Treasury is going to back up these loans, that the 30-year fixed-rate mortgage has become one of the most liquid investments in the world, thanks to the kind of alchemy of Freddie Mac and Fannie Mae. But again, as you kind of point out in the book, this thing has always been fraught I mean, when it became private in 1967, Lyndon Johnson did it, kind of as you said, just to get the debt off the balance sheet and not to honestly account that it would be part of the U.S. debt, even though we're guaranteeing it, which is like such a perfectly Lyndon Johnson
thing. We weren't
thing.
really guaranteeing it, right? There's the implicit guarantee, not the explicit guarantee. So it was really just a game in many ways.
But as you point out, all these investors around the world come piling into this thing, firmly believing the U.S. is behind this, right? That the guarantee is real, even though it's not written anywhere.
Right.
And we're talking huge amounts of money that have poured into this.
Yeah, we are talking enormous amounts of money. Fannie and Freddie, at the time they were taken over by the U.S. government in 2008, had over $5 trillion of debt backed by American mortgages, either outstanding or on their own balance sheets. These two institutions combined are the largest financial institution in the world. And what's interesting is that they haven't shrunk at all in the year since the crisis.
Yeah. So you talk about, this is really interesting to me. By the 1990s, I mean, who could have thought anything would go wrong when you have, government subsidies and bankers working together, right? I mean, but what happens is by the 90s, we see this situation where we've got something that's called the big fat gap, which is this tremendously profitable situation for these two institutions that are very politically plugged in. So could you talk about the big fat gap and what that sort of meant?
So Fannie and Freddie, their main business, their original business, was this buying up of mortgages from original lenders, packaging them into securities, and selling them off to investors around the world. It's a very simple insurance business. They guarantee the timely payment of interest and principal on mortgages. But the two companies began to see an opportunity. They did have shareholders, after all, and they began to see an opportunity to make money in a different way, which was holding those securities on their own balance sheet. Because they have such a low cost of funding, because of this belief that the U.S. government implicitly stands behind them, they could use money they raised in the market, buy their own mortgage product, which yielded a little bit more, and earn the spread between that. It was as close to free money as you can possibly get. It's Alan Greenspan who became one of the most sort of ardent opponents of the two companies, who called this the big fat gap. And it really added to the controversy about these two companies, because it felt like they were taking on all this risk, because there is a lot of risk in doing that. There's interest rate risk, there's credit risk, and benefiting at the expense of the U.S. taxpayers. So the sort of best known line about Fannie and Freddie's business model, and President Obama even said it recently in a speech in Arizona, was heads they win, tails we lose. And the other idea was the gains were being privatized. They were going to Fannie and Freddie's executives, who are extremely well compensated, and shareholders. And the losses were being socialized. If there was a problem, taxpayers would have to step in and foot the bill. So it added to this. The controversy about that business added to the kind of ideological opposition around the idea of their existing in the first place. Why do we need the government in the housing market? Can't we just have private capital do this? Government subsidies are a really bad thing. So it became this sort of huge brouhaha of controversy during the 1990s. Very inside the Beltway, but a huge brouhaha of controversy nonetheless.
And again, with a lot of money at stake and a huge part of the American economy.
Yeah.
And I think one of the most dangerous or kind of insidious elements of this is that it wasn't just a big private company. It was quasi-public, and it turned into this revolving door machine. I mean, it was amazing when you walk through the people who worked there or sat on the board. Rahm Emanuel, Tom Donilon, really high-profile Democrats, but then like Grover Norquist and Newt Gingrich. I mean, this was sort of a machine that had something for everybody. And you talk about its political power, which was incredible.
Former Representative Jim Leach actually described Fannie as the most sophisticated lobbying operation in the history of the modern world. And in fairness to Fannie and Freddie, they knew that there was this strain in the U.S. government that wanted to eradicate them, that wanted to get rid of them. And so they developed this attitude of outsized aggression in response to every threat. The saying around the company was, "You hit my brother, I'll burn down your house," because they felt like any threat was the first step in getting rid of them. And also, in fairness to Fannie and Freddie, their argument was always, well, our opponents aren't pure either. The big banks just want this business for themselves. This is a fight about money. This isn't a fight about ideology. People are cloaking it in ideology and trying to make us the bad guys, but this is a fight about money. The American mortgage market is one of the biggest markets in the world. There is so much money at stake. And I think that was true too. But nonetheless, the Fannie's and Freddie's, but mostly Fannie's, the huge amount of political power they had became another part of the controversy, and may actually have added to the weight against them in the end.
Yeah, and maybe we'll just go ahead and jump to the 2000s and the fire that started burning. But I just love the quote from a congressional staffer in your book who said, Fannie Mae has this grandmotherly image, but they will castrate you, decapitate you, tie you up, and throw you in the Potomac.
Right.
Yeah.
Right.
And I mean, if I was going to create these institutions, I definitely would name them after like two hillbillies and make them sound super innocuous.
Sound like a candy company, right?
Right.
They sound friendly. Right.
It's brilliant. So during the 2000s, though, this is when real problems start to really emerge.
Yep.
And let's deal with the, it starts in the private sector, right? It starts with these sort of private issuing subprime mortgage lenders that start really growing in the 2000s, which was like so well documented. I'm sorry to keep plugging All the Devils Are Here, but you've got to read it.
I appreciate it.
Okay.
Thank you.
So tell us about what started happening as we saw more subprime mortgages being issued, and sort of how Fannie Mae and Freddie Mac reacted to that.
Yep. So this is sort of what led to the conservatorship and why they needed to be taken over in 2008. In the mid-2000s, both companies had accounting scandals, purported accounting scandals, and there's some really odd and strange things about the accounting scandals in both cases. But it led to the ouster of their seasoned executive teams, and from that point forward, Fannie Mae never had the same executive team for an entire year, and this was right at the time when the industry was changing dramatically. Subprime lending actually started in the purely private market. There was a whole breed of companies in the 1990s that saw, oh, you can extend credit to people, mainly in the form of a refinancing or a cash-out refinancing, and have the loan secured by their home. And even if the person can't pay it, we get the house. And this is great. And they began to, instead of selling these loans to Fannie and Freddie, they began to sell them to Wall Street firms who would do essentially what Fannie and Freddie did: package these loans up, sell them as securities, and sell them off as securities to investors. And the rating agencies got involved in the game because, again, investors didn't want credit risk. So the rating agencies came up with this way in which they would carve these securities into various tranches, where the top layer was supposed to have be perfectly safe as safe as anything Fannie and Freddie guaranteed. So these private lenders took off in the 1990s. They all crashed and burned at the end of the 1990s due to the Asian financial crisis. But then by the early 2000s, they were back, and this market was taking off. And Fannie and Freddie began to lose market share because all of these lenders were selling their product directly to Wall Street firms and bypassing Fannie and Freddie. Their market share got cut in half, and so Fannie and Freddie started to have an existential crisis. And so, in an effort to compete and to gain back the market share they had lost, they began to guarantee riskier and riskier loans. There's also another important part of the story that's worth talking about. As part of the legislation regulating them, Fannie and Freddie had affordable housing goals. They were supposed to make a certain percentage of loans to people of low and moderate income, because after all, they're created by the U.S. government to foster home ownership. Don't they need to have quotas for what they're supposed to do? These loans became harder and harder to reach, in no small part, ironically, because the Bush administration really ratcheted them up as a way of putting political pressure on Fannie and Freddie. So I always think it's very ironic when these two companies and the housing goals are treated as a democratic problem. It's just not true in so many ways. But so Fannie and Freddie also began to, and this is, I think, one of the most twisted parts of the story, they began to hold not only their own loans on their balance sheet, but they began to buy Wall Street's so-called private label securities and put those on their balance sheet. And now they were buying what were supposed to be the safest part of the security, the ones that were rated AAA by the rating agency. But can you think of anything more twisted than these two institutions buying loans that have already been packaged up and sold as securities by somebody else and holding them on their balance sheet? And so when the market crashed, all these securities began to display enormous losses, and that was what led to Fannie and Freddie having to be taken over by the U.S. government. And it's a really important part of the story that's worth pausing on, because after the crisis, there have been a number of conservative commentators who have said Fannie and Freddie caused the crisis. These affordable housing goals, the desire to help people who couldn't afford, who were marginal homeowners, the desire to put them into homes, and the presence of the government in this market is what caused the financial crisis. And it's a really important issue. It's almost a religious war in many ways, because if you can say that the entire problem that caused the financial crisis was the government, then the answer is easy, right? Get rid of financial reform, get rid of Dodd-Frank, get rid of the government, and we're all good. We go forward from here. And it is categorically untrue. Fannie and Freddie did part of what they did in order to satisfy the housing goals, and they definitely played a role in blowing the bubble bigger than it otherwise would have been. There are elements of the truth to the story, but risky lending started in the purely private sector, and there are a number of ways you can see that the narrative that this was all Fannie and Freddie's fault is just categorically false. And I'm going to ramble on for one more minute about that and make one more point that I think is really important, because it's this narrative that putting people into homes caused the crisis is just flat out untrue. The big problem that happened is that our homes became a credit card, and homes became a vehicle for refinancing, and particularly for cash out refinancings, where you take a mortgage bigger than the one you had and use the difference in cash to pay off bills, to pay medical expenses, maybe to go on vacation, maybe to remodel your home. But the majority of risky loans that were packaged into securities in the run-up to the financial crisis were actually for refinancings and cash-out refinancings, not used for home ownership. If you strip out the loans used for refinancings and you strip out the loans that were used so people could gamble on purchasing investment properties, you've got a very small subset left over, a subset that in and of itself would not have caused a problem, much less a crisis. So the crisis, I think, is a referendum on giving credit to people. And by the way, giving credit to people of all income levels. There's an interesting study that the majority of defaults came actually from pretty affluent people. It's a referendum on giving credit to people who can't pay it back, but it is not a referendum on home ownership. You know, our longstanding policies to promote home ownership may or may not be a good idea. We can have a separate conversation about that, but I think it's actually just mean and categorically false when you hear that the financial crisis somehow proves that we shouldn't encourage home ownership.
And yet that narrative still is floating around and still alive and well, even though mere facts totally contradict it. And you point out in the book that Fannie and Freddie, when they extended a lot of these loans to lower income people as part of this mandate, they were still like 30-year fixed rate loans. They weren't these crazy risky.
Right. There's a big difference. The way I think about this is that there's a big difference between giving a 30-year fixed rate mortgage to someone who might be marginally qualified to home ownership and who might maybe put down a 10% down payment, but you've documented their income and they've got a job and you know who they are. That might be a good bet. Giving a floating rate loan with no money down to someone who just states their income is an entirely different beast. Fannie and Freddie didn't do the latter kind of beast. They did do the former kind of beast. And it's a little bit like saying it's exactly the same thing if you lend your car to your teenager who promises to drive carefully and be home at 9 o'clock. Yes, that's a little bit risky. It's a little bit of a bet. That's not the same thing as loading your teenager up with a 6-pack of beer and sending them out on a freeway with a car full of 12 kids blaring rock and roll at the top volume. You know what I mean? They're two different things. And the idea that one leads inevitably to the other, and that any sort of that is just, I think it's clearly not true.
For some reason, I'm thinking of Bear Stearns right now. I'm sure they actually did stuff like that during the heyday of giving kids beer.
Right, they might have done that too. You never know.
But nonetheless, over time, Fannie and Freddie became deeply exposed to the subprime crisis. And again, it's because they seem like the flaw here is that they are public in a way. You know, they represent this implicit government guarantee on debt, but they still have shareholders that they have to satisfy.
Totally.
And so they're rushing into this market. They're trying to keep up with good citizens like Countrywide and other financial institutions. And that was somewhat sarcastic. I'm sorry. It was meant to be sarcastic. And it collapses, right? Oh, wait. Yeah. It all collapses.
Yeah. And you could argue, even if Fannie and Freddie hadn't made the decisions they did around entering the market for riskier loans, they still would have had a problem. You take two highly leveraged financial institutions whose only business is U.S. home ownership, and you have a 30% collapse in U.S. home prices, an unprecedented historical collapse, you might have had a problem anyway. But yeah, so the confidence in these two institutions began to slowly die as the crisis accelerated. And you realize what a global issue it was. Hank Paulson tells this story in his book about how he's at the Summer Olympics in Beijing in the summer of 2008, and a Chinese official says to him, you know, we're hearing from Russia that they want to sell all of their holdings of Fannie and Freddie-backed securities in order to create global economic chaos. And there's this great quote from a Chinese financial official to Bloomberg in August of 2008, and they say, if the US government lets Fannie and Freddie fail, it's going to cause global economic chaos. And the way of understanding why this was such a big issue is that these securities backed by the GSEs were held by globally by foreign central banks. They were laced throughout the US banking system. They're used as collateral for derivatives trades. They're used as capital for some of the big banks. I mean, these instruments were and are everywhere. So the idea of letting these two companies fail and having these securities backed by them plummet in value would just have unleashed global economic chaos. There's a lot of controversy around the bailout and around whether Fannie and Freddie really even needed a bailout. I sort of regard that as incidental to the story. Maybe I'm wrong, but I'm a little inclined to give the US government, people in charge, a bit of a break over their handling of the financial crisis. It's easy in retrospect to look back and say, oh, you could have done this better and you should have done that better, but it was an unprecedented time in history. So,
and moving very fast and very chaotic and very, very scary time.
Right.
So what they decided to do was put these institutions into conservatorship, right, which is this bizarre situation that I'd like you to describe. And I think you describe it as being sort of like a pause button to put a Band-Aid on the problem, and then we will figure out how to handle the deep problems later.
Right. So arguably you can date the beginning of the end of the financial crisis, the acceleration of it, not to Lehman Brothers failing, but to the US government's decision to put Fannie and Freddie into this state called conservatorship. And conservatorship itself is not actually a weird thing. It's used by the FDIC to rehabilitate failing banks. You're supposed to take the bank, give it some money, restore it to health, and put it back out in the world. But there were really strange things about the conservatorship of Fannie and Freddie, and the idea was that they would be supported by a line of credit from the US Treasury, and they would be effectively run by a government agency. And the two things that are weird, well, there are a lot of things that are weird about how this has panned out, but one weird thing is you look at the conservatorship of the GSEs versus the rescue of supposedly private sector banks and AIG, and you say, wait, one of these things is not like the other. And then the other weird thing about it is that conservatorship was supposed to be temporary. The company's regulator at the time even said, so when the government did this, they left some 20% of Fannie and Freddie's securities outstanding, trading on the New York Stock Exchange. And they did it because, once again, they didn't want to take all the debt associated with Fannie and Freddie and put it on the US government's balance sheet. So they said, okay, we'll only take 79.9% of the equity of these companies for the government, for taxpayers. We're going to leave the other 20% outstanding. And the company's regulator at the time said, look, this stock may have value someday. This might be worth something. And they left it in the hands of private shareholders. And the idea was that conservatorship would be temporary, and that we would figure out what to do with the companies going forward, what the right resolution was. We would have this broad conversation about how to finance homeownership, about what makes sense. And here we are 7 years later, and there has been no broad conversation. And Fannie and Freddie are still in conservatorship, and if anything, they have gotten bigger. They still own or guarantee over $5 trillion worth of securities. The US government backs the majority of mortgages that have been made since the financial crisis, and there's a really good argument for all the criticism of Fannie and Freddie that we don't really need them. The private sector can do this. Banks can do this. We don't need them. Without the government presence in the mortgage market in the wake of the financial crisis, we would not have had a mortgage market.
And you point out that once conservatorship is in place, I thought it was fascinating. Over the next few years, people tried to come at this problem. And, you know, I guess I would summarize the very conservative view as being kill them,
Yeah.
no more, and we'll let the private market handle it. And then, but the liberal side wasn't willing to tackle this problem either. I was wondering if you could kind of talk about the hard truths people bumped up against, you know,
Right.
2010, 2011, as they tried to solve this.
Well, it becomes a really thorny thing, right? If you want to say kill these two institutions, how do you do it in the wake of the financial crisis where there is no private capital? And by the way, private capital still hasn't returned to the mortgage market. There have been less than 10 billion of these so-called private label securities sold since the mortgage crisis hit. So how do you kill the two institutions at the moment that you need them the most? There are other thorny problems. You've got over $5 trillion worth of these GSE securities outstanding. The primary value of these securities is their liquidity, the fact that they can be bought and sold every day, that they move through the financial system like water. You say we're getting rid of this, even if we're getting rid of it in 10 years, suddenly these securities stop trading. They lose their value. Foreign investors scream, "What are you doing? These securities are plummeting in value." The banking system has problems. I mean, it becomes this very thorny problem of, well, you may say you want to get rid of them, but how do you actually do that? You add to that, I think, this sort of slow dawning recognition that if we didn't have the government in the mortgage market, then in times of stress, A, there would be no mortgage market, and B, our mortgage market would look entirely differently. It would probably have 10 or 15-year floating rate loans rather than fixed rate loans. Mortgage credit would probably be much less available to certain segments of society, or it would be available at a much higher price. You would have huge disparity in the cost of a mortgage. One of the things Fannie and Freddie did was even out the cost of mortgage credit across our country, such that if you were a moderate income buyer in a less desirable area, say in Nebraska, your mortgage wasn't going to cost you a lot more than, say, if you were an upper income buyer in a really wealthy part of the country. If you didn't have this sort of system to accomplish that, you would end up with a lot more disparity in the cost of a mortgage, which I think arguably in a time where income inequality is one of our chief worries, I think would be very, very fraying to the social fabric. So you've got even hardcore Republicans who might want to say, let's get rid of these institutions, we want private capital, when actually faced with the thought of getting rid of these institutions and having their constituents' home prices plunge in value and having people in their districts be unable to get mortgages anymore, they actually don't want to pull the plug. Right. So it's become, the idea of what you replace them with has become really, really complicated. And oddly enough, I think I always considered myself a GSE critic, but when you consider that the replacement would probably be the big banks supplying mortgage credit and supplying and controlling the mortgage system, I'm not really sure why that's preferable to the GSEs. The big banks were GSEs in the financial crisis as well. I think actually I'd take their bailouts over Fannie and Freddie's bailouts. They were a much nicer deal. And although this Dodd-Frank financial reform legislation may arguably have fixed the problem with them being too big to fail, if the big banks controlled the mortgage market in this country, I can guarantee in the event of another crisis they could not be allowed to fail either. So then you're sort of in the same boat where the government actually is implicitly still backing up the mortgage market, except now you have big banks controlling the whole thing. And look, I'm not actually a big bank basher, but I think dispersion of power is actually a good thing. I'm not sure I like the idea of a backroom deal where a politician says, "Hey, Mr. Big Banker, my state could really use some help, some economic help. Why don't you really lower credit standards in order to juice the economy in my state? And in return, I will go light on derivatives legislation." I mean, I would kind of rather the transparency of a Fannie and Freddie like system over that kind of system. Now maybe there's a third way, maybe there's another alternative to this, but if there is one, I have trouble seeing it. So, and I'm open to hearing it if there is one, but it seems to me the most likely event in getting rid of the GSE is giving the mortgage market to the big banks. And I've come to be somewhat more of a pragmatist on this.
Mm-hmm. But you also point out that doing nothing has had real costs. Okay, so they've been in this sort of limbo state because we can't find a solution, in essence, whether we want to totally privatize or what we want to do. I want to point out one of the weirdest parts of your book is that in August 2012, they made a major change to the bailout terms of Fannie and Freddie that essentially, I mean, it's almost a de facto nationalization.
So what the government did, which again is a very different treatment of the big banks or of AIG after the financial crisis, in the summer of 2012, these investors, so let me back up a little bit. These securities that were left outstanding, by 2009, 2010, some smart hedge fund types and investors started to do the work, and they said, oh my goodness, all these losses that Fannie and Freddie are declaring aren't real losses, in the sense that most of them are non-cash losses. Fannie and Freddie had to take huge reserves against potential future losses, and then draw from taxpayers, not based on money they actually needed, but on the idea that they were going to lose money in the future. So when you hear this headline figure of $187 billion that the two companies lost, it's something of an artificial number. So these investors began to do the work, and they said, whoa, 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 all these supposed losses are going to get reversed, and these two institutions are going to be mammothly profitable in a really short term, so we're going to buy these securities. So they bought the securities. And then in the summer of 2012, the government comes along and changes the rules. They say, oh, instead of just taking a 10% dividend on the money we've given you, which was the original deal, we're going to take every penny you make from now until eternity. And the idea that I've heard from the government, the explanation for that was that, well, Fannie and Freddie are losing all this money. They're not going to have the money to pay the dividend. Investors are getting panicky about whether or not they're going to be able to pay the dividend. So if we just say, pay us whatever you've got. If you've got no money, you don't have to pay. If you do have money, we'll take everything you've got. The problem with that argument is that everyone knew Fannie and Freddie were about to be profitable. It was hard not to see it at that point in time. So the government says they didn't see it. You know what? Incompetence is a great factor in the modern financial system. Unfortunately, it's actually worse than outright corruption. It might be true that the government didn't see that Fannie and Freddie were going to be profitable, despite the fact that investors were in there telling them Fannie and Freddie are about to be really profitable. But they changed the rules. And so now you have this really strange situation where you have, in an era where all we talk about is capital. Capital is what will make the banking system stronger. Let's have more and more capital. You have these two institutions, collectively the largest financial institution in the world, over $5 trillion of securities outstanding, operating with next to no capital because the government is taking it all and using it to fund other things, to reduce the budget deficit. There was recently a proposal to use some of Fannie and Freddie's profits to fund highway infrastructure. And you can argue the money's all fungible and it's all taxpayers' money, so what does it matter in any event? But I will promise you, if Fannie and Freddie declare a quarterly loss because of swings in interest rates or something else, the discussion isn't going to be, oh, well, we have to give them $5 billion, but we've gotten $5 billion from them, so it's all okay. There's going to be a huge uproar about these two companies and their drain on U.S. taxpayers, and how can we still be responsible for them? And I guess that worries me. It's this unstable foundation to this thing that matters so much to every single American. I mean, if you have a mortgage, you should care about the financing system that supports it, because this dictates not just the kind of mortgage that's available to you, but the cost of that mortgage. So how can you not care? And even if you don't have a mortgage, if you're just an investor, the status of how homes are financed matters to the global economy and will impact your investment portfolio. And so people should care. I'm not sure there's an easy right answer to it, but people should care.
Well, people should care, and I don't want to keep obsessing on this point, but it was August 2012 when the Treasury passed this Third Amendment and said, we are going to take all the profits of Fannie and Freddie. I don't remember reading about that when it happened, and I don't think...
Nobody cared. So it was this, I mean, it's just this strange, that's the very subterranean nature of these two companies is one of the things that you'll understand. That makes me so interested in them. I mean, they're these two companies that have this enormous impact on Americans' financial lives and around the globe, and no one cares, nobody talks about it. These decisions about how homes get financed get hashed out in back rooms without a lot of sort of public input or caring. And I mean, I think that should change, whatever the answer is. Now, you do have the investors sued. So some of these investors in the securities were some of the nation's biggest, most powerful hedge funds, and they said, whoa, 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 U.S. government, we're not letting you get away with that. We're suing you. So now there are all these lawsuits that are wending their way through the courts. And you can argue, oh, it's just hedge funds wanting a payday. Well, yeah. But I'm something of a fan of the lawsuits, I have to admit, because the lack of transparency around the government's decision and the sort of nonsensical nature of the purported explanation, these two things both bother me. So I'd like to see what comes out in the lawsuits. More transparency, I think, is generally a good thing. And it might be that there was a really good explanation for why the government did this, but I think we haven't heard it yet.
I was really upset that Timothy Geithner wouldn't comment for this book. I just want to get that on the record and say it out loud, because that was such an important decision that was made. It does deserve transparency and a lot of explanation.
Although, in fairness, they're being sued. So when you're in the middle of a lawsuit, it's harder to comment, even if you actually want to comment. And then I think the point of view of people in the government is that the explanation we gave is true. We were worried about Fannie and Freddie's ability to pay, and so we did this in the best interest of taxpayers and homeowners. It's just a little bit strange in light of subsequent events with the enormous profitability of the two companies and the way their profits have been used as sort of a slush fund for the government.
Exactly. And so, and we're going to get to questions here, because I know a lot of people have questions, but I just want to point out that now you've got the government sucking the profits out of these two firms that are just as large. The profits are being used to fund things like the payroll tax cut, which I don't think was broadly understood. And at the same time, it's hurting these companies. Their reserves are really low.
Right.
I was amazed to hear Fannie Mae has a debt ratio level of 340 to 1 right now.
They have no capital.
Well, I remember being shocked back in the days of the crisis when, Bear Stearns and these others, what was it like? 32 to 1. We're talking 340 to 1. That's not healthy. No. And you describe these institutions as having this sort of perpetual low-grade fever right now.
Right. It's also not healthy for two companies to be in a total state of limbo where their employees don't know if their employers are going to be around in 5 years, let alone in 1 year, right? I mean, can all of you imagine that, and trying to keep going to work and doing your job when you have no idea, when everybody talks about abolishing you? I mean, that's not a healthy situation for the long run. And look, the mortgage market is a shark bite shark eat kind of world, or shark eat shark kind of world. This is a market where the most sophisticated global financial institutions are fighting it out on a daily basis, and things that decide and make billions of dollars. And the idea that you have two companies in a state of limbo, sort of with employees who aren't sure that they're going to have their jobs, trying to navigate this market, I think it's not a super healthy thing over the long term. So I've said this is a really scary decision, a scary thing, and it's not scary in the sense that it's going to spark the next global financial crisis. I don't believe that. But my fear is that we get an event where Fannie and Freddie lose a lot of money in a quarter and they have to take money from taxpayers again, or where there's a ruling in the court that sides with the investors and the court says, hey, these investors are owed $100 billion. And it throws the whole thing into an uproar, and we end up making a decision, lurching to some sort of decision. So instead of having kind of a well thought out discussion and plan for how we want to finance home ownership, we lurch into some kind of answer and that affects every American's life. And I would rather, there's a great saying, like, fix the roof when the sun shines, like figure out what to do, put in place a sustainable situation before the government's hand is forced by external events.
And I think that's a great point now to shift it over to everybody. So thank you so much. And the book definitely ends on a worrisome note. So, yeah. So what do we have? Sir, right up front, you have a question? And I guess if you don't mind, just introduce yourself.
Okay, I'm Jim Vitarello. I'm a senior housing specialist at GAO. I've been following this crisis for more years than I can imagine. I've been in housing for over 46 years. And I've been at GAO for about 20. So I know this issue quite well, and I've got to give you a lot of credit for explaining it in plain English, which is very hard for even us to do at GAO. So if you want a job at GAO, you always got one, right?
Thank you. I may take you up on
No,
that.
but seriously,
Journalism
thank
isn't
you.
such a
That
good
was
bet these days.
your explanations were terrific. So my question has to do with the legislation that was on Capitol Hill. I don't even think it's alive and pulsating anymore. Both was it Corker Warner and Johnson Crapo? They were basically hybrid. Not totally private sector, not totally government kind of thing. Could you explain that a little bit and explain why neither one of them had traction, even though they were both bipartisan, sponsored by very powerful senators on Capitol Hill?
Right. So we had a rare bipartisan piece of legislation, and I will give everybody involved just immense credit. They did try to do something. It was Crapo Johnson became Corker Warner, and it was a bill that that passed the committee on bipartisan vote in the spring of 2014. Sorry, I get confused about my years these days. I think it was the spring of 2014, and the bill ended up dying. And the most interesting reason that the bill and I'm not sure it's a bad thing that it died, and I'm going to come back to that. But the most interesting reason that it ended up dying was that affordable housing groups in the end didn't support it. And the reason they didn't support it was that although the bill had explicit provisions to fund affordable housing trust funds for very low income people, it didn't do anything it didn't have any goals in place. It didn't have any requirements for these new lenders to sort of broadly consider the market. And it's kind of, I sort of hinted at this earlier, and I'm going to use sort of an ugly word, but kind of the little secret of the GSEs was this cross-subsidization. It wasn't that they funded super low-income borrowers. It was that they helped even out the cost of mortgage credit across the country. And one of the people involved called cross-subsidization sort of the don't ask, don't tell issue of GSE reform. So the affordable housing fund, people wouldn't support the bill, and that kept a group of very prominent senators, including Elizabeth Warren, from giving it support, and the bill didn't move. I think there's a big question how behind the bill the White House actually was. And they had Gene Sperling working on it at the time, but Obama never did anything to support it. I'm not sure in the end it's a terrible thing that this bill failed, and I'm open to argument on this, but it did recreate a Fannie and Freddie like system where you had the government ultimately standing behind the mortgage market. There was an argument by small lenders that it just turned over control of the market to the big banks, and that small lenders were going to get frozen out of the picture, which I don't think is a good thing. I think diversity among size and scale of banks is actually a pretty healthy thing for our economy, and the mortgage business is a really important part of that. And it basically sort of tore up the whole GSE structure, our existing infrastructure, only to replace it with something that isn't so wildly different. So the bill ended up failing, and I think part of the reason it failed also is the presence of the investors. They lobbied heavily against it because it would have meant no payoff for them. Again, I'm not sure their reasons were impure, or their motives were impure, but I'm not sure their reasons were wrong. I'm not sure it does make sense to tear up Fannie and Freddie only to recreate something we could call Bob and Tom.
Sir, in the tie up front.
I'll stand up because I'm short. My name is Kunio Kikuchi, and I work for an information company formerly with the World Bank. When my daughter went to school, in high school, I could point to the brick wall across Wisconsin Avenue and say, there is the largest financial institution in the world. It still is there. And it still is the largest financial institution in the world in terms of assets and liabilities. The other one is across in McLean, but so few of the people know about it. The thing you didn't say is, what about shareholders like me? This is a profitable business. It's a necessary business. It used to be priced at $60, even $40 for a long time average for the last 20 years until the crisis. And it's supposed to be back there. So Warren Buffett said the only way to make money is to buy low and sell high. So when it was 30 cents, I bought some. when it is now $2, and I recommend all of you to buy it today. It's on the market.
Right.
It's on the market.
Right.
Now, my question is, isn't there a rule in listing a share on the market that all shareholders should be treated equally? Is it fair for the government just to take everything? I mean, it's like stealing.
Well,
They
there's a
should
great-
share the profits.
There's a great line in the
Thank you.
book from, and thank you for that
Thank
point of
you.
view. And you're right, I didn't mention, I had made a point of saying that the investors in Fannie and Freddie are big hedge funds and mutual funds, which, by the way, manage money on behalf of individuals and pension funds. But there are actually a lot of individual investors in this as well. One of the big investors has a great line in the book. He said, look, this is like saying in the financial crisis, you can't pay, so I'm going to take 80% of your house. And then you claw your way back and you're paying. And I say, actually, I'm going to take 100%. And you know, there is some truth to that notion. And your question about shouldn't all shareholders be treated equally is being litigated right now in the courts. And I think it's going to be quite a battle. And I just wanted to say one more thing on your comment. Thank you so much for your nice words. This is such a complicated topic, and there are people like you who know it better than I do, and I have tried really, really hard. So it's nice to hear that I at least got close to accurate in what I did. So.
And with luck, your book might get this into the presidential discussion of 2016, a major looming problem. Could we maybe talk about it for?
No, I think part of the problem with it, someone said to me, and this is true, is that it sounds like it's going to lend itself really nicely to an ideological position, right? Get the government out of the housing market. Isn't this appealing? And then people learn something about the issue, and they're like, oh, not that simple. So then they don't want to talk about it anymore because it doesn't nicely line up with ideological talking points. And I think that's, you know, it's not just that it's really complex. It's that you have to show yourself as a pragmatist and back off some of your ideology if you actually want to get to a solution that's going to make any sense. And I think people are unwilling to do that.
We have a question in the front row.
Yeah, go ahead.
John Nelson with Wall Street Without Walls. I appreciate your comments very much.
Thank you. We have a mic.
Yes. The government, or Fannie and Freddie, don't necessarily have to provide housing security through securitization and through the stockholder model. They could also provide guarantees. The government could just provide a guarantee. The government provides about $1.3 trillion annually of credit enhancements through the forms of guarantees. Jim knows about this. We took the idea to GAO. There's about $10 billion a year that the federal government has in foreclosed assets. A slice of that could be used as a guarantee to satisfy the affordable housing community development sector so that we could have an ongoing standard way of dealing with this crisis.
Yep. I think that's a really good point, and you absolutely could nationalize this function if you wanted to do it that way. I have come to believe, as problematic as the dual structure of Fannie and Freddie is, it's preferable to the alternative of nationalization. And I believe that for two reasons. One is that I don't like the idea of the government being able to control, whatever political parties in power being able to control the flow of mortgage credit. I like the idea of there being some sort of private check on that. I don't love the idea of raise G fees and fund something we want to see funded.
Just the guarantee function. I mean,
Just the guarantee.
Loans.
Yeah, and that could be. I think the banks might find a way to take advantage of it in a way that might, in the end, having this institution that also had a responsibility to its bottom lines, provided a check on the kind of loans that came into the system until you're right, until the end. But it worked really well up until about 2004, 2005. And the standards that Fannie and Freddie set, I think, were rational. And these players in the mortgage market are incredibly smart and incredibly good at finding ways to take advantage of the government. And I worry about having a guarantee function that is solely government owned that would get completely ripped off by Wall Street. So I like the idea of having smart people with some sort of bottom line responsibility engaged in this, as well as sort of a counterweight to that. But you know what? That's the idea of how to solve this is not my strong point. I want to raise awareness of the problem and I've got ideas, but I'm far from sure I'm right, and I'm far from sure that there aren't better ideas.
Back in the middle.
Dave Oxter, I don't know much about what you're talking about, but if you got government out of the housing market, how would it be different than it is now?
Well, I think if you got the government out of the housing market, I think, and look, no one knows. The government has been in our housing market since the aftermath of the Great Depression. So if anybody says they know what the mortgage market would look like without the government, they are lying because they don't know. We've never had that. I think we would have a very different mortgage market. People would be able to get 10, 15-year loans. They would not be able to get 30-year fixed rate loans. I think the price of credit would vary dramatically depending on people's income level, and the availability of credit would vary. And I think in times of stress in the market, there would be no mortgages for people. The private market would shut down. I would add as a comment to that, I'm just not sure that this dichotomy, this supposed dichotomy, private market government, is true today. If the big banks were controlling the mortgage market, I'm not sure that's the private market. I think they operate with a government guarantee as well. So I think everyone who throws around the term private market and then is looking to the big banks, I think you have to at least raise some questions about that.
Back and to the right.
Hi, I'm Arbor Johnson. Thank you. This is really interesting. My question is how HUD interacts with the GSEs, and particularly, I guess, under Secretary Castro.
So in the past, the way the regulation of the GSEs was sort of split, they had this entity called the Office of Federal Housing Enterprise Oversight that supposedly regulated their safety and soundness, and HUD was responsible for their mission, for making sure they met their goals and they lived up to these affordable housing goals that were required of them. I think the Office of Federal Housing Enterprise Oversight has been turned into something called FUFA, the Federal Housing Finance Agency. I love all these acronyms. I think the goals oversight still rests with HUD. I'm pretty sure that's still HUD's responsibility. So one of the things I would say, if you brought anything back that was like the old GSE structure, you would definitely do two things. You would have a strong consolidated regulator that understood how mission interacted with safety and soundness, and you would regulate the GSEs differently. You'd have them be a utility, and you'd have some sort of counter-cyclical measure built in, such that if the market was going crazy, the GSEs were required to pull back. Anyway, that's a little bit of a broader answer to your question, but I think that part of the problem in the old days was that the affordable housing goals were political. And as I mentioned earlier, they were ratcheted up in the Bush administration chiefly to put pressure on the GSEs, to make life harder on them and to sort of show the GSEs who was boss. And that's, nobody wants to go back to that kind of system either. I mean, it was inherently incredibly unhealthy.
Up front.
Hi, I'm Haley. Is this on?
It'll like automatically start.
Oh, okay. I'm Haley Edwards with Time Magazine. I have a very open-ended question. I'm wondering if there's any analogy with what we're seeing in the mortgage market now and what we've seen over the last 10 years with any other industry. And specifically, I guess I've been reading lately about the, I don't know if you'd call it a nationalization, but the movement of all federal student loans to directly under the Department of Education. And now they have a $1.3 trillion debt portfolio. That used to be guaranteed through the banks, as the gentleman in the front row mentioned. And I know that there were a lot of problems with that. I don't understand the industry well enough to know if it's something we can learn a lesson from.
Right. Well, it's interesting and complicated. A lot of people will say, well, Sallie Mae, this big student loan lender, was privatized. Why can't we do the same thing with Fannie and Freddie? But the privatization of Sallie Mae is this really weird thing, because actually the government still guaranteed Sallie a certain level of profit on its loans. So I would say, how is that privatization in any way that anybody thinks of as privatization in this privatized Sallie Mae, it was kind of a monster. You know, it had this rate it could make on its government loans, and then it started being really aggressive about this sort of private student lending. And the private student lending, which has financed a lot of the for-profit education scams, has been, I think, is disastrous for people. And I'm not saying that, you know, and we did all this because the idea about student lending was the idea that the private market was better than the government at extending student loan credit. And what's the private market, first of all? And I'm not really sure that's played out. Some of the worst loans have been made by these sort of private institutions, and so. I just think that if there's an answer, it's that it's not easy, and that this doesn't provide any clear model for going forward. And if there's another comparison, it's that I think both are a problem, and I think they're a linked problem, in the sense that if you have people, a generation who is so hobbled by its student loan debt that it can't buy houses, then you've got more pressure on the housing market. So I think the two problems are linked. I think I would have to think about the parallels a lot more than I can do on the fly. I'll blame my aging and decaying brain, but I think it's a really interesting question, and I think the notion that Sallie Mae was privatized and Fannie and Freddie aren't is just kind of absurd on the face of it.
And a quick point, we talked about some of the problems today. I forgot to mention, I mean, home ownership rates right now are at the lowest level since the early 1980s. So even with this problem is very real that you're talking about here. It's complex, but it's very real to anybody who owns a home in a significant way.
Right. And there's a real question about what the right number of home ownership is, and we shouldn't just push it blindly. You know, it's not that more home ownership is always a good thing. But that said, home ownership has been throughout our country's history the primary way for people of lower to moderate income levels to build wealth. My big thing is that if we're going to push home ownership, let's push home ownership, not the opposite of home ownership, which is the use of your home as a credit card that then loads your home up with debt that makes it so that you lose your home. I mean, I just think the idea that these two things have become linked and we don't separate them and talk about one versus the other, because they're actually diametrically opposed. They're antithetical, and yet we lump in cash-out refinancings and encourage it in exactly the same way we do the purchase of a home, and they are two different things. So.
Well, believe it or not, we actually left out a lot that is in the book. A lot of the amazing political fights just for dropping down the principle on debt was an incredible part of this book. So luckily, we have copies for sale just outside of this room, and Bethany will be here to sign copies. So thank you, everyone, for being here. Bethany, thank you so much for writing this book, for talking about it today. And
could I just make a quick
Yeah,
suggestion?
sure.
Since I do a whole lot of research on this, no one ever really looks at Canada. Okay? Yeah. Elizabeth Warren told me once when I talked to her when she came with CFPB.
Yeah.
I said, Ms. Warren, didn't you basically steal that idea from Canada? She said with a smile, yes, I did.
Oh, interesting.
2001, Canada came out with that. But more importantly, look at a study done by David Min at the Center for American Progress.
Yeah, I know David.
It's called True North.
Okay.
It's an amazing discussion of the whole Canadian banking and housing system and how they use private mortgage insurers, no GSEs. They have a corporation that just does guarantees. You know, it's just a slice of the market only for the really high-risk people, etc. I won't go into detail. Read that book.
I will.
For some reason in this country, I don't understand why, right? Both here in Washington and Wall Street, we never really look at Canada for any ideas, even though they're remarkably similar to us. Now, I realize the differences, of course.
Right.
Right? But it always blows my mind. Why do you ever hear people say, "Oh, gee, Canada's doing something really great. We should look at that"? They were the only industrialized country in the world that did not have a housing recession. Right?
Yes, and you know what? That's a great point, and I will read that. And since I grew up near Canada, I'm going to say go to the Great North.
There you go. Nice note to end on.
Yeah, I love it.
Okay, well, and Bethany's here for any questions or conversation. Thank you so much for coming. Really appreciate it.
Thank you very much. What?
Are we looking at the future?